Imagine waking up every month and seeing an extra $1,000 land in your account. No boss, no extra hours, no stress, just consistent income generated while you sleep. That's the power of dividend investing. And the truth is, it's not reserved for Wall Street insiders or people with millions in the bank. In fact, with the right strategy, patience, and a bit of discipline, building a $1,000 per month dividend portfolio is something almost anyone in the United States can realistically achieve. But here's the catch. Most beginners either chase high yields blindly or give up too early because they don't understand how the system actually works. So in this video, we're breaking it down step by step from beginner to advanced, so you can build a reliable income stream that grows over time. At its core, dividend investing is about owning pieces of companies that pay you a share of their profits regularly, usually quarterly. Think of it like getting paid rent, except instead of property, you own stocks. Companies like blue chip corporations and established dividend payers distribute a portion of their earnings to shareholders. And if you structure your portfolio correctly, those payments can become a predictable monthly income stream. Now, here's where most people get confused. If you want to earn $1,000 per month, that's $12,000 per year. And depending on your average dividend yield, which typically ranges between 3% to 5% for stable investments, you'll need roughly $240,000 to $400,000 invested. That number might sound intimidating at first, but remember, this is not something you build overnight. It's a long-term system powered by consistency and compounding. When you're starting as a beginner, the focus should not be on chasing the highest dividend yield. High yields often come with higher risk, and many investors fall into what's known as a dividend trap, where a company offers attractive payouts but is financially unstable. Instead, you want to focus on financially strong companies with a history of increasing dividends over time. These are often referred to as dividend aristocrats, companies that have consistently raised their payouts for decades. Pairing these with dividend-focused ETFs can also help you diversify and reduce risk while still generating steady income. As your portfolio grows, reinvesting your dividends becomes the real game changer. This is where compounding kicks in, allowing your investments to grow exponentially without requiring significantly more capital from you. As you move from beginner to intermediate, your strategy evolves. Instead of just focusing on safety and growth, you begin to optimize for income consistency. This is where investors start building what's called a dividend ladder, strategically selecting stocks and ETFs that pay out in different months, so that you create a smoother, more frequent cash flow. Some investors even structure their portfolios to receive payments every single month, even though most companies pay quarterly. At this stage, tax efficiency also becomes important. Dividends in the US can be taxed as qualified or ordinary income depending on the asset. So holding investments in tax-advantaged accounts like a Roth IRA or 401k can significantly improve your net returns over time. Understanding how the IRS treats your income is just as important as the income itself. When you reach the advanced level, the focus shifts toward maximizing efficiency and scaling income. This is where you start blending high-quality dividend stocks with slightly higher yield assets like REITs or covered call ETFs to boost your overall portfolio yield while maintaining a balanced risk profile. Advanced investors also pay close attention to metrics like payout ratio, free cash flow, and dividend growth rate to ensure their income is not only high but sustainable. At this level, you're no longer just investing. You're managing a cash flow machine